Let's take a look at how the performance of the markets impacted the Wespath fund returns. With that, I will turn it over to my colleague Karen Mansko for the update.
Thanks, Joe, and hello, everyone. I'm going to start off the performance discussion by first talking about our flagship balanced portfolio, the Multiple Asset Fund. As a reminder to our viewers, the Multiple Asset Fund has a long-term strategic allocation to 65% equities, 35% fixed income. It's also important to note that there's been no changes to the strategic allocation within the Multiple Asset Fund since our last update. On the slide, you can see the allocation the Multiple Asset Fund has to each of the individual Wespath funds. What I also like about this slide is that it really showcases the broad level of diversification the Multiple Asset Fund offers our investors. The next chart shows the net of all fee performance of the individual Wespath fund composites versus their respective market indices. As Joe noted at the beginning of his update, since we are GIPS compliant, we will be showcasing the composite returns during the webinar, which reflect the combined performance of the I series and P series funds. When I move on to talk about the attribution of each fund, I will then focus specifically on the I series. Looking at the first column, it showcases the third quarter performance results. We did see some market decline in the third quarter that had impact on 4 of the Wespath funds that comprise the Multiple Asset Fund, which were down for the quarter and modestly underperformed their benchmarks. Focusing on the 2 equity funds, which are the first 2 funds listed below the Multiple Asset Fund on the slide, these 2 funds comprise about 65% of the Multiple Asset Fund and were the primary driver of the quarter results of the Multiple Asset Fund. What impacted these 2 funds were stock selection by the underlying active managers. I'll highlight in a moment specific companies that have impacted the performance. Also, the U.S. Equity Fund has an underweight allocation to mega cap stocks, which are the largest U.S. companies. This detracted from performance as we saw strong gains from these stocks for the quarter. On a positive note, the 2 equity funds allocation to private equity contributed to the fund's performance, as we've seen strong results posted from this asset class for the quarter and also year to date. Moving on to the 2 bond funds, starting with the fixed income fund composite. Looking at the chart, you can see that both the composite and the benchmark were relatively flat for the quarter. The Inflation Protection Fund composite posted positive results for the quarter, surpassing the fixed income fund, but underperformed the fund's custom benchmark by roughly 0.5% net of all fees. Despite the near-term underperformance we experienced from the Multiple Asset Fund, looking at the longer term, the performance of the fund outperformed its benchmark net of all fees for the 1, 3, 5, and 10-year time horizon. Just to highlight as I conclude on this slide is that we've seen a rotation in the markets that started transpiring last year and this year. The stock market as a whole has been up year to date, but the areas of the market that are outperforming are much different than what outperformed last year and even in the years prior. At Wespath, when we make investments and allocations to various asset classes, we make them for the long term. And we don't try to get swayed to make drastic changes in our funds by near-term out-of-favor investments and strategies. As we've showcased, our long-term strategic approach to investing has served our investors well in the long term.
So Karen, I know we like to show the Multiple Asset Fund versus its index, but how did the Multiple Asset Fund perform relative to its peers?
You're right, Joe. We not only like to measure how the Multiple Asset Fund compares relative to its benchmark, but we also want to show how the fund compares relative to its peers using a peer composite that's compiled and maintained by our custodian Bank of New York Mellon. The information on the slide is updated only through August, since the September data is expected to be released later on this month. You can see looking at the chart that the Multiple Asset Fund has outperformed the median foundation and endowment portfolio in the 3, 5, and 10-year time horizon, and performing in the top quartile for the 10-year, which means it outperformed 75% of its peers. In the 1 year, we were below the median, and the reason for this is because relative to foundation and endowments, the Multiple Asset Fund has a smaller allocation to alternatives, such as private equity. In the Wespath funds, we posted nearly 40% gains for this asset class year to date. And foundations and endowments that are part of this comparison likely have 20% or more invested in this asset class, and the multiple asset fund has roughly 4%. We understand that some of our investors would like a higher allocation to alternatives, which is one of the drivers behind us launching our own fund next year.
So Karen, moving on, tell us about the individual fund contributors and detractors for the quarter.
Starting with the multiple asset fund, and I talked briefly about this on the performance slide, but you can see the primary driver of the fund's underperformance for the quarter was the modest underperformance of the 4 funds that comprise the multiple asset fund.
So I mentioned during my comments that we continue to see strong performance across the broad market year to date, but some equity markets were flat or even down for the third quarter. How did this impact the U.S. equity fund performance?
Yeah, that's right, Joe. The markets gave up some of its return in the quarter, which happened in the month of September, since we saw in August that the markets were at an all-new high. The only U.S. stock market that ended in positive territory for the quarter was the S&P 500, which was up only about 0.5%. This obviously had a negative impact on the U.S. equity fund quarter performance, since the fund has a long-term strategic bias of being underweight large cap stocks, which primarily is mega cap stocks, and has an overweight to small and mid cap companies. And those companies were down 1.4%. You'll notice on the slide that we mentioned the underweight to mega cap stocks as being a detractor to the performance rather than just stating large cap. And the reason is because our fund is really underweight mega cap stocks such as Google, Microsoft, and Apple relative to the fund's benchmark.
So how much is the fund underweight mega cap stocks relative to the benchmark?
The fund is underweight roughly 13% when compared to the Russell 3000, which is the fund's benchmark. Another detractor that the fund had was the active all-cap growth manager stock selection, specifically in healthcare and technology. Companies such as Teladoc and RingCentral were down 37% and 24%, which is quite a difference from last year when these companies posted such strong results. So for instance, Teladoc was up 138% last year. This year, we saw that migration out of growth stocks names into less growthy names, which has impacted Teladocs and companies like it. But on a positive note, the fund's allocation to private equity contributed to performance, as I noted that private equity investments this year have posted some really solid returns. Next, turning our attention to our international equity fund. The international developed markets did not decline as much as some parts of the U.S. market, but were still down about 0.5%. Emerging markets were down over 7%, which was primarily due to China, which was down 18%, as you noted during your market update. The detractor to the fund performance was similar to the U.S. equity fund, where stock selection by the fund's active managers were the main drivers to the underperformance. Alibaba, which is China's version of Amazon, was down 36%. Also, a German e-commerce company called Zalando, which is an online fashion and lifestyle platform, was down 24% this year after being one of the top stock performers last year.
So it seems like the main driver to stock selection in the 2 equity funds that you just reviewed are companies that were in favor last year and even the year before are now out of favor this year. Is that a fair assessment? And have we seen our active managers make changes to their holdings in light of the stock selection issues?
Last year was an extraordinary year in the equity markets, and I think it's worth reiterating that our investment managers invest in companies that they believe will generate outsized returns over a multi-year period. They do not invest to capture just short-term gains. In fact, one of our most successful managers has been invested in a third of their portfolio companies for over 10 years. This manager likes to say they invest in companies that save time, lives, money, and headaches, or provide exceptional value to customers.
So moving on, looking at the fixed income fund performance, I noted during the market update that bonds have improved slightly compared to the rocky start at the beginning of the year. Specifically, high yield bonds have done well, up 4.5% year to date. Global bonds, mainly emerging markets, have not fared as well due to some of the political issues transpiring in those parts of the world and also the low vaccination rates. How did this impact the fixed income fund performance, given that it has a global fixed income portfolio?
Yeah, it has been quite a challenging year for bonds, with the exception of high yield and U.S. inflation-linked bonds, which I'll talk more about during the Inflation Protection Fund update. As you showcased earlier, high yield bonds are up 4.5% year to date, with other bond asset classes in negative territory. The U.S. aggregate Treasury index is down over 3% year to date and 4.5% for the 1-year time period ended September 30th. So when you compared the yield curves, you can see how yields increased from the end of last year to the end of the third quarter, which had a negative impact on the bond market year to date. It's also worth mentioning that the US dollar increased relative to emerging market currencies during the quarter, which had a negative impact on those allocations in our bond funds. With this said, the fixed income fund underperformed its benchmark for the quarter. Just focusing on the left side of the slide, looking at the contributors, is the fund's overweight allocation to high yield bonds positively contributed to the fund performance, along with issue selection by our emerging market debt and core plus managers. Detractors to the fund performance include the overweight allocation to global and emerging market bonds, specifically emerging markets, as we saw the dollar increase relative to those currencies during the quarter.
So Karen, the dollar had a negative impact on the fund's allocation because we hold non-dollar bonds. So what did we see with the dollar, or why did the dollar increase during the quarter?
There are really a lot of reasons why the dollar's outperforming other currencies. And there are many factors that impact currency movements or valuations. Some could be confidence in our Federal Reserve, confidence in our GDP growth, but it could also be that relative to developed markets, the interest rates in the US are higher. Therefore, the carry trade is alive. I find this interesting. If you borrowed in yen at the beginning of the year and invested in short-term US interest rates, you would have made 8%. The final piece I'll mention before we move on to the last fund, the Inflation Protection Fund, is the impact that our internally managed positive social purpose lending program and commercial mortgage-backed securities, it detracted from the fund. And the reason is because we saw spreads widen in this market sector, which negatively impacted the quarter returns.
All right, so moving on to our final fund, the Inflation Protection Fund. This fund has posted some solid gains this year that you highlighted during your update earlier.
Yeah, despite the modest underperformance by the Inflation Protection Fund, it's really showcased its purpose this year as being a fund that was created to protect investment portfolios against unanticipated inflation while providing a stream of income. So relative to the fund's custom benchmark, the fund is underweight global and UK inflation-linked bonds, which performed well during the quarter. The interesting thing to know about UK inflation-linked bonds is that the duration is quite long.
How long is the duration for UK linkers?
I believe the longest maturity is 50 years. And what this means is that this asset class is very sensitive to interest rate increases. The UK is experiencing inflation concerns like the rest of the world. Therefore, some actions that may be taken by the Bank of England to control inflation, which is to raise rates, could have some volatility for this asset class. Moving on, despite the U.S. Treasury inflation-protected securities having a strong performance year to date and for the quarter, the fund's overweight allocation to this asset class detracted, as it couldn't keep pace with the fund's benchmark, which includes a 10% allocation to commodities. As I noted earlier, commodities were up about 29% year to date and over 6.5% for the quarter.
Yeah, Karen, that's a great point you make regarding commodities. So the Inflation Protection Fund is a 10% allocation as they posted strong results throughout 2021 so far. So I don't see them listed as a contributor on the attribution.
It's a great observation. As I mentioned, the fund has a 10% allocation to commodities, which has been a strong driver to the fund's absolute performance. For the quarter, our commodity returns were relatively in line with the commodity index. Therefore, it did not contribute or detract to the fund's performance. Therefore, it's not listed. The last update before I officially turn it back over to you, Joe, is that the fund's out-of-benchmark allocation to floating rate senior secured loans detracted. And the reason is quite similar for the reason for the U.S. Treasury inflation protection securities and why they're listed on this slide. This asset class had great returns, but senior loans underperformed the fund's custom benchmark.
Thanks for that update, Karen.